So I've been living in India now for the best part of 20 years. I think it's my 16th year in India. I've rarely seen the Indian economy's macroeconomic outlook being as positive as it is today. It's very rare to see a country where at the top of the interest rate cycle, and we are at the top of the interest rate cycle at the moment. At the top of the interest rate cycle, you have real GDP growth in the 7.5% mark. That's unprecedented in Indian history, and I suspect it's a very rare occurrence anywhere in the world in a free market economy. Right. So if you keep that in mind, that at the top of the interest rate cycle, GDP growth is already pretty healthy. Over the next 2 to 3 years, as interest rates come off across the world, India's economy should improve further. In addition, you have a reasonable amount of political clarity as to how elections will pan out in May of 2024. And the combination of healthy macroeconomy, political clarity, strong balance sheets in corporate India. I think corporate India's debt equity ratio is the lowest it's been in almost 2 decades. Banking system where tier one capital is 17 or 18% amongst, I think, the highest in the world. No large economy will have a banking system with tier one ratios this high. So the overall macroeconomic outlook is incredibly positive, and bodes well for corporate earnings over the next 2, 3, 4 years. Now, if you link the strong economy to the stock market, naturally, if you have an economic outlook which is positive, it boils over into positive stock market sentiment. I think what's further helped India is the financialization of savings over the last 5, 6 years. So historically, as per RBI data, historically around 95% of Indian households' balance sheets were in physical assets, gold and real estate primarily. What we have seen over the last 5, 6 years is gradually part of this massive investment in physical assets. Part of that is turning to financial assets. So, my back of the envelope rule suggests that Indian households' net worth would be around $10 trillion. So, using RBI data, $9.5 trillion of that would be physical assets. And what we are seeing effectively every year is 1% of that toggle, 1% shifting from physical to financial. So roughly 80, $90 billion a year shifting from physical to financial assets. And as that happens, if you keep pouring in lots and lots of money into the financial system, life insurance, general insurance, mutual funds, PMS, alternative assets, as you keep pouring in financial assets, as households keep saving through the financial system, the cost of capital goes down. So the 10-year Government of India bond yield was in 2003 around the 13.5, 14% mark. Today, that same 10-year bond yield is 7%, right? Sharp drop in the cost of capital. Naturally, if the cost of capital drops in a country, that helps everybody. Lower cost of capital fuels further economic growth. It also fuels the stock market. So strong economic outlook, financialization of savings, constant drop in the cost of capital, good for the stock market. And if you look at large cap stocks in India, large cap stocks are up 17%, 18% in the last 12 months. That's broadly keeping pace with corporate earnings. So I'm fairly constructive on large cap stocks. Where I think there's a bit of concern is the runaway rally in small cap stocks. I think small caps are up 50% year on year. Over the last 3 years, small cap indices would be up 150, 160%. And that's a cause for concern. I think what's happening is the retail investor is pouring into the stock market, into small caps, and arguably a bubble has built up there, and one needs to be cautious about that. So overall, stock market looks in good place, specifically large caps. Be a little careful of small caps. And if I look back at 2023, I think that's been my big learning, that the economy is in a good place. Large cap companies, well run, large companies, solid earnings growth around the 20% mark. If you invest in them, your portfolio compounding, my portfolio compounding through 2023 in large caps was the best part of high teens, low 20s. But the small cap piece is something I became very, very wary of as 2023 progressed. And by the end of 2023, my view to myself, to my colleagues, to my friends was only stay invested in really high quality small caps, because life has taught me that if in a raging bull market where small cap valuations are running up, but fundamentals are not keeping up, it's a little dangerous to be overexposed to overexposed to small cap, right? Now I'll link that to the broader importance of financial planning, right? I've written about this extensively in my book Coffee Can Investing, the low risk route to stupendous wealth. And one of the things I've written about and tried to practice is that my exposure to the stock market should only be with money that I don't need over the next 5 years. So in Coffee Can Investing, what I've explained is the simplest way to do financial planning is to say, first create a safe harbor. So assume that your safe harbor is roughly 3 to 4 years of annual household expense. So if, for example, if my household expense every year, my wife, myself, my children, if, for example, we need say 30 lakhs a year to live on, uh, my point of view will be, let's put 3 to 4 years of savings in a fixed deposit. So the best part of a crore should go into a fixed deposit. That's our safe harbor. That's the money that we'll take out if something untoward were to happen in our lives. The rest of our savings is what I allocate to equities, right? And I break that equity allocation into 70% large caps, 30% small cap. If you're younger than me, you might want a more aggressive allocation than that. And if you're older than me, you might want a more defensive allocation than that. But the simplest way to go about doing this, as I said, is figure out what your annual outgo is. What's the minimal amount of money you need to live a decent life? Multiply that number by 3 or 4. Give yourself that 4 year cushion. Put that money in government bonds or in FDs. That's your safe harbor. Don't try to make money of that. That's your cushion for a rainy day. Take the rest of your savings and allocate that in broadly a 70-30 ratio. And by all means, use a financial planner. On the SEBI website, I think the 1300 or 1400 registered investment advisors IDs given. Choose a good investment advisor to give you a financial plan so that your equity allocation between large and small caps is done properly. Follow basic financial hygiene, right? So as my friend Monica Alan writes about in her personal finance books. I think Monica has written a lovely book called Let's Talk About Money. Follow basic personal finance hygiene, which is have insurance policy, have a life insurance policy. So my wife has a term life policy. I have a term life policy. Over that basic foundation, build your personal financial plan. Hopefully, Coffee Can Investing, my book, will give you some basic pointers towards that. But my suggestion is get a registered investment advisor to create a financial plan for you. From that financial plan, will follow the asset allocation. And so think of a financial plan as almost a GPS map, right? A Google map, right? If you don't know where you're going, then you even if you have the best car in the world, even if you're the best car in the world and you invest in the hottest fund ever, if you don't know where you're going, your car's not of much help, right? Whether your car's engine is 3 liter, 1.5 liter becomes irrelevant if you don't know which direction you need to navigate your car in. Very similarly in investments, it's no point having a high-powered fund with great returns if you don't have a financial plan, right? And in that context, I think Indian mutual funds obviously have become a medium of mass saving in our country, and it's an absolute joy to see the mutual fund industry go from strength to strength, become a medium through which millions of Indian families are able to give voice, give shape to their financial aspirations. Right. So I used to be on the mutual fund advisory committee set up by the regulator. I saw just how committed the regulator is to making mutual funds a safe, well-run, high-quality avenue through which mass savings can be promoted, all the way from a few thousand rupees to crores of rupees. Using systematic investment plans has become the default mode through which households in our country are saving for achieving their life goals. And if you take this further, right, if you look at India over the next 10 years, if the economy continues to grow at a reasonably healthy rate, 6-7% is very healthy by any standards. If 6-7% economic growth continues, corporate earnings at the index level continue to grow at 10-12%. Right? So 6-7% real GDP growth translates into nominal GDP growth of 10-11%. Well-run companies should be able to grow their profits a little faster than that. So 13% profit growth. If you're invested in these companies, your wealth should compound in the low teens. Low teens wealth compounding, apply the rule of 72, tells you that every 4 to 5 years, your wealth will end up doubling. And if your wealth doubles every 4 to 5 years, and you keep stacking up your savings over and above that through augmenting your pot of wealth, you should be headed for a very prosperous retirement. Or indeed, if you have other aspirations such as sending your children for higher studies, buying a dream holiday home either on the beach or in the Himalayas, all of that will work out with a disciplined financial plan. Right. So that would be my suggestions on financial planning, the stock market, and the economy. One broader point I would like to make is, I think it's all very well for people like me to sit in Mumbai and sit in the money center of the country and opine on the market or on the economy, but without financial awareness, without investor education, this message is not propagated out to the public. And I think that's where a lot of the credit should go to that whole constituency of people who are taking the message to the masses, that if you want to benefit from India's economic growth, come into the stock market, through mass financial savings products like the mutual fund industry, and a lot of credit should go to that constituency. And in that constituency, I would also include the Nivesh Mahakumbh, where investor education is propagated the right way for the masses.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.